Welcome back to Trendlines Over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My name's Patrick Dunawilla. I'm the editor of the Chart Report, and I'll be your host. Our guest today is none other than Sam Rowe. Sam is a highly respected financial journalist and market analyst. He's currently the founder and editor of TKer, a newsletter geared towards longer-term investors that covers the stock market and the economy. In the past, Sam has written for some of the largest financial media outlets, including Forbes, Business Insider, Axios, Yahoo Finance, and many more. Sam and I approach markets very differently. I know the trend lines, Sam knows the headlines, so it's going to be a great conversation. But before we talk to Sam, it's Friday, the markets are closed, so let's take a quick look at how this week played out. The major indices ended the week on a sour note with a nasty sell-off heading into Friday's close. All four major indices ended in negative territory for the week. The Dow led but still fell more than 1%. The Nasdaq lagged, closing lower by about 3% this week. Taking a quick look at the S&P 500, it was rejected at resistance from the March 2022 highs around 4,600, and we ended up closing at the lows of the week. The next major support level to watch in the near term is about 3.5% lower at last August's highs around 4,300. Now, taking a quick look at the sector performance, energy was the only sector that closed higher this week, gaining a little more than 1%. Utilities lagged, dropping more than 4.5% on the week. Anyway, that's enough from me. Let's welcome Sam onto the show. Sam, welcome onto the show, and thank you for joining us today. I'm excited to have you on.
Thanks for having me.
Yeah, we really appreciate you taking the time. I know you've had a pretty crazy week between the that ceiling leak and then you got shut out of Twitter. Is that correct?
Yeah, my two-factor authentication codes that I was getting from Google Authenticator stopped working, and I tried reaching out to Twitter to see if there's a workaround here, but they said that this is how robust two-factor authentication is. It's so tight that even the owner of the account can't get in unless you're able to generate those codes. So I don't know exactly what happens next, but for now I'm locked down indefinitely.
We normally have technicians on the show, but I'm a big fan of your work. I love your Twitter account, so it is too bad that you got shut out like that. And I really like that you can find the humor in the markets. The late Bill O'Neill had a great quote. He said, "The stock market is human nature on parade." And I think there's a lot of comedy in human nature. And if that's what markets really are, there's plenty of laughter to be had there. Would you agree?
Yeah, for sure. I mean, if you think about like the Greek classics, right? Like they usually categorize them as either a tragedy or a comedy. But, when you go back and study that stuff, it's like you really can't tell the difference between the comedy and the tragedy. It's like there really is a fine line between comedy and tragedy. And, it's all sort of reflections of human condition. And so in many ways, all the stuff that, we as humans go through very much manifest, in the markets. And the markets very much inform, how we're going to respond in our day to day. So, yeah, I think that makes a lot of sense. But yeah, I guess maybe finding the humor is sort of a way of coping with more difficult times.
It's a coping mechanism, I see. But so before we dive in, could you just give us a little bit more background on you and, how you got started in the financial news, some of the places you've worked, and what you're up to nowadays?
Sure. Yeah, I mean, I think if anyone's been following my work at all, they know me from Business Insider and Yahoo Finance. But my start actually my start was back in 2005, where I was working as a paralegal at a corporate law firm that was I won't get into too much details, but I got a lot of exposure as to how the equity research process was done, and I just got really fascinated by it. And I started reading about how fundamental analysis is done, and I read a little bit about how technical analysis is done, and how markets work information out and reflect those understandings through pricing. So I started reading up on stocks. I eventually got a job at Forbes, where I worked in their newsletter division. They actually.
And what year was this? Because you're getting kind of close to the great financial crisis.
Oh,
there,
yeah.
right?
Oh, well, I mean, it actually worked out kind of nicely from an educational perspective, because I started in 2006. Doing bottoms up research for stock picks. So we'd publish 5, 6, 7 stock picks a month. Using some screening tools and stuff. And I was responsible for helping with the research and modeling some of the numbers using DCF analysis. But yeah, this was in 2006 and 2007 and 2008 and 2009, where the first 2 years of working there, I thought that the team I was working with were geniuses, because everything was going up. And then
don't confuse brains with a bull market. You know what they say.
Exactly. But then, of course, things sort of petered out and turned in 2007 and 2008, and then I learn to appreciate that it's not just about the absolute returns, but if you're doing well on a relative to your benchmarks, it's okay to be down. But yeah, from 2006 to 2010, while I was working at Forbes, I was also enrolled in the CFA program and eventually earned a CFA charter through that whole process. But yeah, it was really a good time. I mean, it was a terrible time, right, in the world, but it was a great time to be learning about the subject matter, especially with the CFA program. You learn a lot about fixed income markets, and that stuff can be just incredibly difficult to understand. But every day you were reading about mortgage-backed securities, asset-backed securities, CDOs, all this stuff, credit default swaps. This was all part of the curriculum, and it's being taught as these amazing tools that you can sell on Wall Street. And then, of course, while I'm studying this, all this stuff blows up. And so
that was part of the curriculum.
It was part of the curriculum, yeah. So wow. As I'm trying to understand what's going on in the news, I'm now reading about this stuff in the textbooks and understanding how, the securities were structured and how risk was allocated and tranched and all this stuff. So yeah, it was great. So it was a lot of securities analysis during that period. Unfortunately, in 2010, even though this is like the beginning of the bull market and the economic recovery, every industry is affected a little bit differently, and Forbes was still struggling with sort of the aftermath of the financial crisis, which took down its biggest advertisers. So
and at the same time, you had this interesting kind of transition probably between the old school newspaper news and this new internet news kind of thing. Is that
absolutely
true too?
Absolutely? Yeah. If anything, I think I benefited from being at Forbes and then joining Business Insider in 2011. So that was the next chapter, where Business Insider was not really well known back then at all, but they were known for producing a lot of interesting content that people were clicking on, including a lot of stuff that used a lot of very aggressive headlines and images to tell their stories. But there was some really cool stuff that was happening there in terms of markets coverage. Joe Weisenthal of Bloomberg was one of
right.
He was one of the early editors. He was my boss for about 5 years at Business Insider. And so we worked together to build out the Business Insider markets team, which, in some ways it was kind of like a counterbalance to what Zero Hedge was putting out there, right? Using a lot of really good research and information that's like really sophisticated, but the challenge for us was trying to, tell some of these stories that, aren't super scary, but like are a little bit hopeful, and like try to get the attention of readers to click into some of these stories that really mattered. So yeah, 2011 to 2015, I was at Business Insider overseeing their markets team. And then I went to Yahoo Finance to become their managing editor to help sort of re-envision how they were going to think about news coverage of financial
I mean,
markets.
at that point, Yahoo Finance was pretty much all that was left of Yahoo, right?
Yeah, hey, depending on who I don't want to offend anybody if they get shared this video, but I'll put it this way: Yahoo Finance was extremely powerful, and continues to be, because 90, 100 million people a month go to the site for data.
Oh, yeah. I mean, I know so many people that's just their default thing. I don't know if it's just because they've been doing it for years, or I mean, the data is really good too.
Yeah, I mean, it's I guess it's one of those sort of sticky relationships that exist, right? Once you've set up your tools and your portfolio, and you get comfortable with how to adjust all the settings and stuff, and the fact that they have a ton of data, for free. It's very difficult to convince people to move to another site. So yeah, so the challenge was, how can we get people who are coming to the site for data to engage with more, or to stay on the site, not go elsewhere for other things. So we worked on building out an original content team while also curating great articles from third parties.
Nice. And so now you have TKer. So tell us a little bit more about that. I recently just subscribed, so I'm excited to see more stuff.
Yeah, thanks. So TKer is sort of, I would say a different kind of news experience, and I think it really just kind of comes down to the incentives, right? Like I think that, I mean, you can call this a criticism. I mean, well, actually, a lot of people would call this a criticism, but I think the incentives in big financial news aren't always completely in line with the reader's interest, which might be, trying to get information that'll inform their finances and their investments, right?
Right.
The big news has a responsibility to answer the questions that readers have, and sometimes, it's. We're talking about human nature. Sometimes it's not human nature for us to gravitate towards like the scariest things and like the high risk, long tail outcomes. And you might have 50 people telling you that the economy is in great shape, but then you have one person saying that the entire thing is going to fall apart because of, some shoddy argument. And the eyes are going to gravitate toward, that perspective. And then it feels like it becomes a responsibility of a big news organization that's trying to attract a lot of attention to publish against that. So so TKer is kind of a response to that, and it's a reaction to what I've been hearing from readers, since my Business Insider days, where there's information out there that helps long-term investors, and not necessarily like the short-term traders of the world, that helps long-term investors have a better sense of what's going on in the markets and the economy. And so basically what I'm doing with TKer is, taking the same data and news and information that we see on CNBC and Bloomberg and the Journal every day, and frame it for an audience that has a long-term investment horizon on their minds. And sometimes it's not about, whether or not, the monthly jobs reports misses or beats expectations, but, what does the actual new data tell us about the long-term trend? And so that latter thing is what I'm trying to serve the audience with.
That's awesome. I think that's a great concept. And I really like what you said there about human nature and kind of this need for us to explain things. When you see this crazy move, a stock makes some big outsized move, we're not comfortable as humans with that uncertainty of not knowing why that might have happened, even if it was just caused by some imbalance between supply and demand or something like that. There's that urge to have some sort of explanation, some sort of reason. And I think that, that's human nature right there. So I really like that point.
Yeah.
But, you and I have very different approaches. I'm strictly technical, and I kind of go out of my way to ignore news so that I can, just focus on price action, and I don't get, influenced by other things because I really just want to focus on price action. Whereas, you are a journalist. And the show is called Trendlines Over Headlines, so it is kind of these two different approaches. But I want to kind of explore those a little bit more, and I think by the end of it, we can probably reach some common ground. And I think we already do have some commonalities. I think what you're doing with TKer in terms of trying to help the person at home while still being that kind of news element, we share that right there. Chart Report kind of has that too. But let me start off by this, and you kind of touched on it, but what would you say your biggest frustration is with the traditional financial news?
I think my biggest frustration is, the sort of implication that, the way a story is told and the way a piece of information or data is presented by whatever the news outlet is, the implication that this is, designed to help you make decisions about your finances. It's not necessarily that it's completely void of it, but it can be very confusing because, a certain piece of information framed a certain kind of way might be incredibly valuable to someone who's trading with a short-term time horizon. But that same story can mean something completely different for someone who's very long-term, who's now thinking, wait a second, I need to shift my, allocation, reduce my allocation to equities because, I want to be able to retire in 40 years. Whereas, the information might not be suitable for that sort of audience. So I think that's sort of my biggest frustration. It's not so much that, I don't think anyone really has any sort of, malicious intent, but I do think that, financial news tends to be a little bit more oriented toward folks with a shorter time horizon in their mind.
Yeah, I think that's a fantastic answer. I never thought of one of our frustrations with the news, financial news, being based on that whole differences in time frame thing. On our show, we had Dan Russo on probably about last year, and he said 99% of all the debates on FinTwit come down to differences in time frame. And it's kind of similar with what you're describing with the news, right? It can be really, really useful to a short-term trader who's acting on that right in the moment, just looking to maybe day trade something or short-term. But it could be really harmful to an investor who's been holding this stock for the long haul, and then all of a sudden they see a scary headline and they bail out. So I thought that's a really interesting answer there.
I think sort of coverage of the monthly jobs report is sort of a great example of how one piece of factual information can be framed two different kinds of ways. So the July jobs report comes out and 180,000 jobs are created in the month of July. And so, to an average person who's really not following anything, the gain of 180,000 might sound pretty good. 187,000 new jobs and employment in the United States reaches a new record level. This is all good news. However, a lot of the headlines today are being run with, labor market disappoints. 100, just a, lowest job creation number, since, 2020, fall short of expectations for 200,000. Listen, all this information is very true and important and might lead to some volatility into the markets and may explain what's going on, today or tomorrow and maybe how the Fed thinks about monetary policy. But, if you're sort of a little bit more long-term oriented, the news today is that the economy got a little bit bigger. more people got jobs, more people have money in their pockets, and that means more people are going to have money to spend into the economy.
Yeah, I think that framing part of it is really important there. And like another example, like this week, we had that US debt downgrade and we saw a little bit of weakness the day after. What was that, on Tuesday or Wednesday? Either way, yeah, we could blame that weakness on the US debt downgrade, but it's also happening after a massive, relentless rally. So are we that shocked here? Here we're entering seasonally challenging period, and we've had such a strong summer that do we really need a reason to blame for a little bit of weakness? So it's all about that framing, right?
Yeah, and I think especially with like mainstream news, and again, this is not a criticism. I respect.
And of course, we're generalizing when we talk about the news. Right?
Exactly. But the market reaction to like the Fitch downgrade, it's funny. As soon as the downgrade happened, every single expert on the planet comes out and says this is not a big deal, and this doesn't change anything about what's going on in the world. And even from like these technical perspectives, like some people were worried that if you downgrade a sovereign rating, then certain bond funds or whatever are going to be forced to sell, except that's actually just not the reality of how a lot of these funds work. And so, everyone was on one side saying that this was not going to be news. And then, sure enough, you have a day where there's a ton of volatility in the markets. But again, it's incredibly difficult to attach, one piece of news to one day's worth of market action. I mean, God knows what was going on with, positioning and a lot of these other technical things that, guys like you are always talking about that might have the market set up in a way where it's going to react a certain way in a particular day or a particular week where, market technicals or something related to, positioning or something is going to make things vulnerable and move things in a certain kind of way over a short-term period.
I know you're not a technician, but you talk to all different types of investors out there. And so I wanted to get your read on sentiment right now. So we have this chart here. This comes from eToro. Our mutual friend, Callie Cox over there, created this chart, and it's kind of loosely based off of like Justin Mames's, he's a famous technician, his sentiment framework that he has. You've probably seen this chart dozens of times, but gun to your head, Sam, where would you say we are on this sentiment cycle?
Boy, that's a pretty dangerous question, isn't it? But
you got a gun to your head, so
yeah. I mean, I think based off of like my read and between and listen, we all see all the different sentiment surveys and from both institutions and at the retail level. I'm gonna say that we're somewhere between relief and optimism. And I think a big part of that, I definitely think we've exited the disbelief phase, right? And I think a lot of that is reflected in what's going on with Wall Street strategists raising their price targets for the S&P.
I'm glad you went there. I was kind of going there, but yeah.
Yeah, I mean, it's funny when you talk to some of these strategists and people who understand how that business works. A lot of the times, what the strategists are saying are kind of a reflection of what their clients are feeling, right? So, you come into the year with the expectation for extremely modest gains. I think half of the strategists were actually expecting either flat or negative results for 2023. So I would characterize that as disbelief, especially in the context, now that we have the benefit of hindsight of seeing the stock market up 20% since the beginning of the year. All the strategists are now revising up their targets. They're not, fortunately, they're not super anchored where, I mean, there's a couple who still think that, we're going to be down 20% by the end of the year. But for the most part, most strategists have been revising up the targets with the understanding that maybe the reality is a little bit different in terms of the outlook for the market. So we're probably in the relief phase. And I would say that we're probably only beginning to get toward that optimism. I don't think that we're way past that because, again, like
So we're not at belief or enthusiasm yet.
No, I don't think we're quite at belief yet because there are certain surveys that will also tell you that people are still, quite bearish. JP Morgan has a weekly client survey that goes out where I guess the net percent of clients saying that they're going to raise their equity position is near record low. So
Really?
sentiment at the JP Morgan institutional client level is still very poor. The Bank of America has their fund manager survey that they publish every month, and the appetite for risk is extremely low among those respondents. And I think, and going back to like the Wall Street strategists too, who again often reflects the sentiment of their clients. I believe the last I checked, I believe that the average price target among like the top 20 major strategists is implies a decline in the S&P 500 from here to the end of the year. So
the average.
Yeah, the average. Yeah,
among
average.
What, like 20 strategists, or
I think it's about 20. It includes all the strategists at the bulge bracket banks and all that stuff. But just generally speaking, there is not quite. I don't know if acceptance is probably should be a bullet here.
It should.
I guess relief and belief is sort of a form of belief is kind of a form of.
But Sam, that's okay. You can put acceptance in there if you think that's the stage we're at. I think you just added a new bullet point here.
Yeah. I think that's right about where we're at. I'm not willing to say euphoria or enthusiasm quite yet. People point to valuations being a little bit above historical averages, but we're also sort of expected to see earnings rise pretty considerably over the next 2 years. So I'm not quite sold on the whole valuations is stretched quite yet.
Yeah. Well, so I know you brought a few charts along with you. I haven't had a chance to take a look at them yet. So would you mind breaking or just walking us through them real quick?
Sure.
And Sam, you're going to have to explain these to me like I'm 5 because I'm not sure what's going on here.
Okay, this one is a kind of a complicated one, but I think what we can just go with the headlines of both of these charts. So Figure 15 is the degree to which net profit margins for S&P 500 companies are beating expectations in their Q2 results. And then Figure 16 is the EBIT margin. So this is a company's profit margin when you exclude the impact of interest expenses and taxes.
Okay.
Basically, the difference between the percentage difference between your sales or your revenue, the top line, and what the company is actually earning or profiting or taking home.
What they're retaining.
So, one of the big stories of the last 2 years is, corporate America has somehow, despite rising costs and inflation, have been able to keep profit margins very high. They have been ticking down, in the last 2 or 3 quarters, but still they are way above, the pre-pandemic trend levels. So, there's been the expectation that margins were supposed to, really start to shrink in Q2, especially now that we're sort of experiencing a mini earnings recession. But so far, and I believe this is through earlier this week, so with about 50% of the S&P 500 reporting earnings, so far companies are reporting profit margins that are a little bit better than expected. So the real elementary way of thinking about this is the ability of companies to maintain a high degree of profitability continues to be very strong, even though they're still sort of wrestling with higher costs, and they are all actually dealing with what seems to be a little bit of a cool down when it comes to sales. So this is basically an unexpected development that has come from earnings season. You read headlines all the time about how, most companies, like 80% of companies so far have beat expectations. There's a lot to unpack about what that actually means. But I do think it's very important that we're seeing profit margins beating expectations, because that's another area where, the sentiment, I don't know if it's really sentiment, but the analysis that was coming from a lot of analysts were saying that this was supposed to be a really bad quarter for margins, and that's just not the case.
Right. It's almost like the rise we've seen over the past 8 months or so has kind of been foreseeing that. Maybe, they say the market is forward looking usually about 6 months or so, and so that kind of fits, right?
Yeah, absolutely. I think not only is it possible that the markets were predicting this for the last 6 or 8 months, but I think that the strength of the market right now, understanding this, it is now sort of the expectation for higher profits in the months and years to come are going to be that much stronger, right? Because one of the things that I guess they're not talking about it as much because it's not as big a story. But what they had been talking about a lot, and this is a pretty important story, was that we were experiencing an earnings recession in the stock market, right? So Q2 earnings, as strong as they've been, are expected to decline on a quarter-over-quarter basis. However, if revenue and sales and businesses are supposed to improve from here, if companies have pretty strong profit margins ahead of what's an upswing in demand and sales, then that's extremely bullish for earnings, for profits, because for every dollar of sales of sales growth, it's some form of some increasing multiple in terms of earnings.
Right, that makes sense. That's it seems like a pretty positive one. I think we could put it in that bucket, right?
Yeah, it's at the very least, it's not as disastrous as people were expecting.
Right, and that's enough. That's enough to not be terrible. So what's going on with this one? Tell us. You got total non-farm unemployment.
Yep. So this is a ratio that gets tossed around. This is something that we often hear from Federal Reserve officials and economists, talking about how tight the labor market is. So what you're looking at here is the ratio of job openings. So the numerator of this is total non-farm job openings. That's just a technical way of saying how many job opening listings exist out there on the market.
Okay.
The denominator here is the number of people who are unemployed. And so right now this ratio is sitting at about 1.6, which means that there are 1.6 job openings per unemployed person out there.
Oh,
now,
wow.
so this is a trend that has, earlier in this recovery, it was about 2 to 1. There were 2 job openings per unemployed person. This has come down a little bit, but the bottom line is it's still way above the pre-pandemic record levels. And so what this means is that the labor market continues to be very tight, in that a lot of companies still have positions to fill. And this is something that helps to explain why job growth numbers continue to be positive month after month. It's because a lot of companies are actually telling us that they need more people on their staff. Like, it's one thing that companies are doing well enough in terms of sales and earnings and all this stuff, but what this metric is telling you is that companies could be doing better if they had more people on their staff. So this is a leading indicator, a potential leading indicator of things to come. As more jobs get filled, you're going to have more people with money in their pockets, and that gets spent and gets thrown back into the economy, and the economy continues to grow.
That's interesting. And you certainly have seen the narrative around some of these tech layoffs kind of dying down. Would you agree with that?
Oh, yeah.
There was really, really, you heard all about it back in the end of last year.
Yeah.
A lot of layoffs going on. And I thought it was really unusual seeing that into the holiday season. I feel like companies won't lay people off around Thanksgiving and Christmas and all that, but they were doing it anyway. I think we saw record layoffs for the year in like November, maybe. I could be wrong. You'd have to go back.
Yeah, well, why don't we actually skip two charts ahead? The last chart that I gave you,
sure.
That actually addresses exactly what we're talking about. Okay, so there are two bars here, and so what we're looking at is the monthly pace of hires in the economy and the monthly pace of layoffs in this economy. So the bar in the red, red is sort of a bad color, so we're going to have layoffs in red. The bar, so you can see this huge spike in 2020. So that's when the pandemic hits and everything shuts down and everybody starts cutting staff and sending people home, right? But aside from that, what you'll see is that red bar, pre-pandemic, in the years before and even at the current days, in normal times, and this is during a growing economy with lots of net job creation, there's somewhere between 1.5 to 2 million layoffs happening every month. 1.5 to 2 million. That's a big freaking number in the context of numbers, right?
Yeah, and like just to emphasize that, what you're talking about there, I mean, that was a healthy market period, basically before COVID. And you're saying, correct me if I'm wrong, but the red line, the bad line, the layoffs, those were actually elevated. Those were higher than they are now.
Yeah, right now it continues to be depressed. So the number of layoffs. So you have approximately, I think in the most recent month, there were 1.5 million layoffs in June. Again, big number, very difficult for all these people who are affected. But that represents 1% of the employed workforce. Is it the civilian labor force or the employed workforce? Either way, it represents 1%. It represents 1% of the labor force. Again, very difficult for those affected, but 1% is a pretty small number in the grand scheme of things. And I should also note that we've heard a lot about tech layoffs, but information tech and internet businesses and sort of the surrounding businesses that whole industry is responsible for a little, like somewhere between 1% and 3% of total employment in this economy. So while we read all day about, Mark Zuckerberg and Jeff Bezos and all the Facebook millionaires and all the people who are studying STEM to work in Silicon Valley, that is actually a very small part of the employed workforce. So it's almost hard to even see where the spike in tech layoffs happened here, because while, it was definitely significant, that industry definitely had its sort of labor recession and might still be going through that now. You heard things like a white collar recession and things like that. Yep. Yeah. It's all those things. The magnitude of those layoffs, including the white collar, and I know that there's still a lot of happening in media, financial services. God forbid, you're trying to, you're in the mortgage business where the activity is just really not great. There's a lot of industries that are really struggling, and a lot of people are hurting. But at the national level, the story is very different. Yeah, I think that's a really fascinating point. And like I said, especially the fact that we could sustain a healthy stock market during that period where this was significantly, I mean, maybe not significantly, but it was more elevated than it is now, even with that whole narrative of tech layoffs and stuff. And it's rough for them, but the point is that the market can sustain this level of layoffs or this pace, right? Yeah, and it's just sort of like, sort of the ugly realities of reality, right? Like, there's just always a lot of bad things going on. And, I do think this gets back to, how I feel about, media coverage of a lot of these things, that I think it's really important that if you are going to be covering stuff like tech layoffs, it's very important to put that in the context of what it means nationally, because people see those headlines and they see those layoffs, and it's going to affect their behavior. It's going to affect their decisions. It's going to freak people out. But like, the reality has been that, unless you are working in tech and you're adjacent to tech, or, you work on Wall Street, you're in pretty good shape. most industries are, continue to hire. If anything, most industries can't seem to find enough workers to fill all their job openings.
Let me ask you this, and it's kind of related, but do you think, the narrative behind AI replacing jobs, do you think that's overblown, or do you think that's a legitimate fear?
I think it's a little bit of both. I definitely think that there's probably gonna be a lot of jobs that will be affected. Maybe there become less openings, but I think we'll have to see exactly. I hate to say it, but we'll have to see how this plays out. Like, I think one way, AI can manifest in the labor market might not necessarily be through actual layoffs, but maybe companies decide that, hey, we're a lot more efficient. Our output is up. We don't actually have to fill that job opening that we put out there. So I think there's definitely a possibility that some industries decide that they're going to take down some of their job openings as they move people around within their company to address what might be higher efficiency, thanks to being able to fold some of these AI technologies into the workflows. So, maybe if all things being equal, if a company is not looking to grow revenue, then yeah, maybe AI replaces some workers. But as far as I can tell, it seems like the idea of having more efficiency introduced. And listen, big corporations, publicly traded stocks, everyone, their interests are aligned to maximizing profits. And a great way to maximize profits is to have sales go up as you are increasing your profitability. So I think what happens is that, maybe employment levels don't really change, but the output starts to go up pretty significantly. So yeah, I'm not totally sold on the idea that AI is going to be devastating to the economy. Definitely, some jobs like I don't know, anything. I mean, especially with a lot of these chatbot types of AI that are coming out. You know, putting together a slide deck might take a third of the time or a tenth of the time, right? Drafting an interoffice email to your team, or like an announcement about how we're going to have the company party is over here and over there. Instead of having someone waste 30 minutes drafting this, you can just have, ChatGPT create a prompt. In 30 seconds, you make edits for 5 minutes, and then suddenly you have 20 minutes back in your day. I think stuff like that, we're going to hear about a lot more in the coming years.
Yeah, that efficiency. Well, I appreciate your thoughts on that one. I know there's no really right answer to that question, but it's time to wrap it up when we're talking about AI and the future of AI. So, but Sam, thank you so much for coming on the show. I hope your weekend gets better. I hope your Twitter account gets unlocked. I love all the hilarious tweets you have on there. It keeps me going throughout the day. But before you go, tell us a little bit more about TKer. Where can our audience find TKer? Where can they get the free version, the paid version, and follow more of your work?
Sure. I think the easiest way to find it is to go to TKer.co. So that's TKer.co. And you can sign up. I have all my recent newsletters are sitting on the website, and you can also sign up for free. And if you sign up for the free subscription, you get a newsletter every Sunday. And if you sign up for a paid subscription, you get 2 or 3 more during the week. And that includes a lot of stuff that's a little bit more real time, that might be in response to news that's happening.
I've been getting the free one for a few months now, but I just subscribed to that paid one. It's only $9 a month. Our audience should certainly go check it out. It's really
And if we're talking about metrics, the renewal rate is very high among paid subscribers, and the open rates, the people who are on the paid subscription are very engaged. So all that tells me is people seem to be pretty happy with their paid subscriptions. So I hope some people think about signing up. But yeah, this Sunday's issue that is going to address some of the drama that's happened in my life this week, and I think I think it does kind of speak to it does offer some lessons in terms of long-term invest in the context of long-term investment.
I can't wait to read it. Well, hey, have a great weekend, and I hope to have you back on the show sometime.
You bet, anytime.
Cheers. Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.